Welcome to the NAIFA webinar series, providing you with timely information and training on topics of interest. This is Brendan Burnett, Director, Professional Development and Education Programs. Today we are presenting Social Security is an Investment. Help your clients understand it. Your clients have made a valuable investment by paying into the Social Security system over their lifetime, and most tend not to think about this investment until something happens, such as a loved one passes away or a family member becomes disabled, etc. And unexpectedly, they are presented with an unfamiliar situation that prompts them to turn to their financial advisor for Social Security guidance. And this presentation is tailored to prepare you for just these types of situations. The presenter is Vonda Ventile. She is a Social Security Public Affairs Specialist in Grand Rapids, Michigan. And with over 26 years at Social Security, Vonda is well-versed in all aspects of Social Security and has conducted numerous educational webinars, radio and television interviews, and training sessions. And in fact, Vonda has done numerous webinars, such as this one for NAIFA. Seems like about this time every year, and we're thrilled to have her back again this year to provide this vital information. This is always, I think, probably our best attended webinar throughout the year. So welcome back, and thank you, Vonda. And this will also be an opportunity for you to take advantage of some Q&A time at the end to ask some of these difficult questions to Vonda so she can give you her expertise. During the webinar, she will show you online tools that will enhance your retirement planning process, and she'll also share some inside tips of the best way to work with Social Security and their online services. During the webinar, you may type your questions in the question box on the right side of your screen, and all questions will be answered during the Q&A session at the end of the webinar. This webinar is being recorded, and a web link to the webinar recording will be emailed to you later on following the webinar. Vonda, welcome to the webinar.
Thank you so much. I appreciate that, Brendan. And thank you all for attending the webinar and wanting to learn more about Social Security. I'm just going to get right to this slide because this is kind of my intro to you. The reason that I feel so strongly in educating financial professionals is because we know the public goes to you for their questions, just like Brendan's intro indicated. And Social Security representatives can answer questions, but we are not allowed to give our opinions and suggestions as far as when to file, what is the right time to file, that type of thing. And that's why this webinar is so important, so that we can kind of share information with one another. I understand the types of questions you all get, and this webinar is actually incorporating real live questions that I've gotten throughout the year from financial planners. I put them in this presentation to help us understand how every segment that I talk about is going to help you in your career and with your clients. So the slide we're looking at, making the right decision, this is the #1 question that the public has. And they're probably going to go to you with these, with the questions that you see before you. So I appreciate you wanting to learn more. So what is the right age to file? I don't know. We at Social Security do not ask individuals, you know, what are your retirement plans? What is your income and your assets and your resources, and how's your health? We don't get into that. We are not financial planners. We literally expect the person to know when they want to file when they contact Social Security. So the things that they need to think about is the early versus delayed. That's obvious. Do they want to go early and have that permanent reduction in their benefit? Do they want to delay past their full retirement age and get a permanent increase in their benefit? Have they considered how work can affect those Social Security benefits? Anybody that wants to get their Social Security before their full retirement age has earnings limits. So for some individuals, it just doesn't make sense to file early. Do they understand how their retirement benefit is calculated? I just had a gentleman in one of my seminars the other day. He was so excited because he had been working a lot of overtime towards the tail end of his career, and he really felt like that was going to pump up his Social Security substantially. And I had to let him know that we use 35 years in the benefit computation. So the last 3 years are going to help, but not help near as much as I think he anticipated, because that's just 3 of 35 years. And your clients, if they have dependents, a spouse, a divorced spouse, Those are definitely factors to think about when it comes time to making the decision on when to file. If you don't file early, or if you don't file at your full retirement age and you delay filing, well, then know that everyone else that could potentially get benefits on your record also has to wait. It's not like they can file when they want, even though the worker hasn't filed yet. Leaving the workforce early, very popular question that I get. Hey, I want to leave the workforce prior to being 62 years old or prior to being 65. Is that really going to hurt my benefit? So it's something to think about. Taxation concerns. A lot of people don't realize that Social Security benefits don't have any taxes taken out of them, but that doesn't mean the IRS doesn't want to know about all income that we have coming in. So collecting Social Security could very well put your clients in a higher tax bracket, which means maybe they want to wait a year. Maybe they want to wait until they're done working for the whole year and then file for Social Security just for the sole purpose of taxation. And finally, but probably one of the main concerns, is health insurance. Your clients aren't going to get Medicare until they're 65. So do they have insurance that's going to cover them if they do leave their place of employment prior to the age of 65? So we're going to get into all of that good stuff. Here's a client question that I got. My wife is going to be 62 next year, and she would like to file for Social Security, but we have no idea if she has worked enough. So the answer to that question, or my response to that advisor, is, well, she has to have 40 credits. We know that. How do you get 40 credits? Well, you have to work a minimum of 10 years to obtain those 40 credits. You gross $1,300 in 2017 and you've earned 1 credit. You gross $5,200 in 2017 and you've earned 4 credits. You could not earn any more than that 4. 2018, the dollar amount for 1 credit has gone up. Next year it will be $1,320 gross. And so once an individual makes $5,280 gross or net from self-employment, then they have their 4 credits. So the first question would be, well, did your wife work a minimum of 10 years of work? But for some people, it takes them 15 years, 20 years to get those 40 credits. So after discussing that, I would also recommend that client's wife get a My Social Security account so that she can look at her statement. We're not sending those statements out any longer. Now the only individuals getting a statement in the mail are those that are 60 and older, and they're only going to get the statement in the mail if they haven't created a My Social Security account. So I would recommend to that advisor that the wife get a My Social Security account, look at her statement, because that is going to tell you how many credits she has. If she has 40 credits, it will give you a retirement estimate, and it will not indicate that she's not insured. If you're not insured, it'll tell you how many credits you have and how many you need. Client question, if I file at 62, will my benefit increase when I turn full retirement age, or is it a permanent reduction? This seems like a very obvious answer. A lot of people are like, who would ask that? But you know what? We are asked that all the time from the public. That is not common knowledge, that filing early means a permanent reduction in their benefit for the rest of their life. It is not common knowledge, and one that we have to remind individuals about. Here's a chart to show everyone's full retirement age. So you find your client's year of birth, you move to the right, that's their full retirement age. You move to the right, and that's their percent if they file at 62. You move to the right, and that's their percent if they wait until they're 70 to file. So we have a permanent reduction if they file before that full retirement age, and we have a permanent increase if they delay filing after their full retirement age. And of course, you can file any month you want in between there. It just depends on the situation with their work, etc. The delayed retirement credits are what we call that boost in your benefit if you delay filing after full retirement age. And that boost is equivalent to 8% per calendar year, but it's monthly. So as you can see, anybody born between 43 and 54, their full retirement age is 66. They're going to get a 25% cut in their benefit if they file at 62. On the flip side, they're going to get a 32% boost in their benefit if they wait until they're 70. And this is a chart to just show how the benefit goes down when you file early. The benefit goes up if you file late. And I am showing annual amounts, but it's monthly. An individual doesn't have to wait until their birthday each year to make a decision on when to file. It's monthly. Once someone turns 62, they're good to go. They then need to decide what month do they want to begin collecting that benefit. I will tell you that somebody has to be 62 for the entire month in order to qualify. So if somebody was born, say, November 15, they would have to wait until December, and then they would get their December check in January if they wanted their benefits to begin then. You have to be 62 for the entire month. Client question, we found out my wife has 40 credits. If she files for retirement on her own record at 62, does that make her ineligible for spouse's benefits on my record? Again, very common question. A lot of people, a lot of clients won't have the wife file at 62, and they'll just have her wait for when he files because they're afraid that it's going to mess everything up if she files on her own early. The answer to this question is she absolutely can file at 62 if she wants to, and she still can get additional spouse's benefits on the husband's record later once he files. So let's take a look at the spousal benefits. Spousal benefits are 50% of the workers on reduced benefit. Well, first I should clarify that a spouse is a legal marriage. So most of my examples are the woman filing on the man's record, but a man can file on the woman's record, and we also have same-sex marriages. So it's a legal marriage is the definition of spousal benefits. So the benefit is 50% of the workers on reduced benefit, and that is key. It's 50% of the workers on reduced benefit. So if we looked at, I'm just going to go back and look at this chart right here. So looking at this chart, if, let's say, my husband's full retirement age is 66, and his benefit at 66 would be $1,000. I am his wife. I want to file for spouse's benefits on his record. The most I can get in this example that we're looking at, the most I can get is $500 because I'm eligible for 50% of his full benefit. So what if my husband actually filed at 62 and started collecting that $750? I still am eligible for 50% of $1,000. What if my husband waited until he was 70 and collected $1,320? I still am only eligible for $500. And that's if I wait until my full retirement age to file. If I file before my full retirement age, it's going to be reduced. So that $500 that we just looked at, that would be reduced if I filed early. Now, the third bullet point is addressing a very common situation, which is, you know, a woman works outside the home. She has her 40 credits. She wants to file on her own record. If her own benefit is less than half of her husband's, she can also file as a spouse. So in that earlier example we looked at, half of my husband's is $500. If I can only get $200 on my own record, I can file on my own at 62, and then when my husband finally decides to file later on, then I can file for the additional spousal benefit at that time. If I'm eligible for $200 on my own at my full retirement age, I'm eligible for an additional $300 on my husband's, which would give me exactly half. Now, if I took that $200 on my own early, then I'm eligible for that reduced benefit on my own plus that $300 on my husband's. But again, that $300 would be reduced as well if I don't wait until my full retirement age to file. If I do file on my husband's record, I'm not going to reduce his benefit at all. Question, I have an ex-wife. She has told me that she will be filing on my record for benefits. My wife and I are very concerned about this. Is there anything that we can do? Nope, there is nothing that they can do. They might be concerned about it, but they don't need to be, because if the ex-wife's eligible to file on his record, she absolutely can file on his record. It doesn't matter that he has a current wife. If the ex-wife is unmarried, she can file on her ex-husband's record, and his current wife can file on his record. So let's take a look at that. We have benefits for divorced spouses. So you have to be married for at least 10 years prior to the divorce, and you have to be unmarried. You must, of course, be the same age as a regular spouse, a current spouse. You have to be 62 or older. And again, if your own benefit is more than half of your spouse's, you are not going to file as a spouse. So if, for example, in my household, I work full-time, my husband works full-time, I know my own benefit's not going to be less than half of his, and vice versa. So there is no spousal benefit payable. It's the same for the divorced spouses. If I've worked outside the home my whole career, then my own benefit's probably going to be more than half of my ex-husband's. But if it is less than half of my ex-husband's, then it's the same as a current spouse. I can get what I possibly can on my own, and then I can also file for additional divorced spouses benefits. Very important point is that asterisk, the second to the bottom, where it says if you have been divorced at least 2 years and your ex is at least 62, you can file on your ex's record, even if he or she is not retired and has not filed. That is huge. That is such a big point to understand, because if I'm currently married, I can't get a dime on my husband's record until he actually files for Social Security benefits. But if we're divorced and we've been divorced for at least 2 years, my ex-husband, he has to be 62 or older, but he doesn't have to retire, he doesn't have to file in order for me to be able to collect divorced spouses benefits on his record. That's a big difference between a current spouse and a divorced spouse. And again, if I did file, like this question, we'll look back at this one. You know, they're concerned, him and his wife are concerned about the ex coming on the record. They're probably concerned because they think the ex is going to reduce their benefits. And the ex will absolutely not reduce anyone else's benefits on that record. As I mentioned in the beginning, another thing to think about, you know, in addition to the spouses, the ex-spouses, is the children. Does your client have a child under the age of 18? Because if your client does, that might impact when they make a decision. You know, if they wanted to wait until they're 70 and they have 2 kids under the age of 18, they might want to file earlier because those kids are eligible for 50% of the worker's full benefit amount until the age of 18. Also, if your client has a child that was disabled before the age of 22, and we say child, but you know, your client's in their 60s, their child, if you will, is probably 40, 50 years old. But if that child was disabled before the age of 22, as soon as mom or dad files, they are eligible for 50% of mom or dad's benefits. I just got this question not that long ago from an advisor. I have a son who's 42 and receiving SSI. He was born with a disability. Does he have to file on my record when I file? So this was a question that this advisor's client sent in. The son is on SSI. SSI stands for Supplemental Security Income. It's a needs-based program that pays disability benefits. The disabled son didn't work. He wasn't able to work, so he couldn't get Social Security disability because you have to work and pay into the system. So he's only getting SSI. And the father was concerned that the son had to file on his record. And the answer is yes. As soon as dad or mom files for Social Security, that disabled adult child will also file on their record. It's called Disabled Adult Child Benefits, and they are required by law to file because SSI is a needs-based program. When you're on a needs-based program, you are required to file for all benefits that you're due. Now, the father didn't really want him to file because he thought he would lose his Medicaid. But he will not lose his Medicaid even though he's switching over to Social Security as long as he's utilizing his Medicaid. Now we're going to get into some strategies, and this was just a perfect question that I got in, and I'm like, this is perfect for my presentation today because it really does define the strategy that we're going to talk about. I will be 66 in October of 2017, but I do not plan on retiring. Can I restrict my application to spousal benefits in October and continue working? My husband has already filed. Then when I'm 70, I'll file for my own retirement. And the answer is yes, absolutely. This person can do that. Why can this person do that? Well, let's break down the question. They're 66 in October of 2017, so we know their full retirement age is 66, and we know they're going to be full retirement age in October. What that means is in October, this person can make as much money as they want, and nothing happens to their benefits. We don't care how much someone makes once they turn full retirement age. We also know that this person's husband filed, which is key. So because this person, and I'm just going to transition, because that person asking that question was born before January 2nd, 1954, they absolutely can file for just spousal benefits, continue working full-time, and then they can switch to their own later on. Maybe they want to wait until they're 70. Like the question said, can I wait till I'm 70? Yep. So she's going to receive 50% of her husband's full benefit. And then when she's 70, she's going to file for retirement on her own record and collect 132%. Now that is a strategy that is going away. So if you've ever been on any of my webinars in the past, we used to talk about this as a strategy for everyone. And unfortunately, that has gone away as a result of the Bipartisan Budget Act. So they're grandfathering people in, which is why you see those two boxes. For those born on January 2nd, 1954 or later, they don't have that choice. They can't say, hey, I just want spousal benefits to let mine grow. They can't do that. You basically have to file for your own retirement first. And if your own retirement is less than half of your spouse's, you can also file for spouses. But if your own retirement is more than half of your spouse's, you do not get a spousal benefit. However, individuals born before January 2nd, 1954 have a choice. They have to be full retirement age, and that's key. This woman could not do this if she wanted to file prior to her full retirement age. So if she asked if she could do that in January of 2017, the answer is no. You have to file for retirement. But she's asking in her full retirement age month. Okay. I would like to retire when I'm 58. Is that going to greatly affect my Social Security benefit? Very common question, as I mentioned in the beginning. A lot of people want to leave the workforce early, or they think they want to leave the workforce early, so they want to know what impact that would have on their Social Security benefit. The best tool for this question right here is the online retirement estimator. That is the best tool to use. This is how you are going to get the most accurate Social Security retirement estimate. So we talked earlier about the online Social Security statement. That was where I showed you where people can see how many credits they have. The online statement does provide estimates, but for the retirement estimate, that statement is assuming that your client's going to work until their full retirement age and until age 70 and until age 62. But what if, like in this example here, what if they want to retire when they're 58? Then we need to get a more accurate estimate, and that would be the online estimator. The online estimator allows you to put in what-if scenarios. So you just put in that you don't do this for your clients. They have to do it, or they have to be with you when you're doing it. You can't enter clients' information without them being with you. So we enter in the client's information, and we indicate they want to stop working at age 58. So you see that red circle? That's where it's indicating, hey, what if, and the client's making $90,000 a year. What if I'm working and making $90,000 a year and I leave the workforce when I'm 58 years old? Well, at the age of 62, that person would get $16.94 a month. Versus the online Social Security statement is going to give the bottom three estimates. But the top three estimates are based on our what-if scenarios. What if I stopped at 58? What if I stopped at 60? And what if I stopped at 65? And those are the estimates based on those scenarios. So it's a super helpful tool to let someone know what their benefit will be if they do end up leaving the workforce early. Which leads me into how we calculate a retirement benefit. As I discussed in the beginning with my one example of the gentleman who worked a ton of overtime the last 3 years, he was so excited. And then I had to deflate that excitement, unfortunately, by indicating, hey, we're going to use 35 years. So what do? We pull out an individual's highest 35 years of earnings. A couple key points with that. You do not have to have 35 years. When we went over the credits, I indicated that you needed a minimum of 10 years of work or 40 credits to be fully insured. So if somebody only worked for 10 years and earned 40 credits, they're fully insured for Social Security retirement benefits. We would use all 10 years, and then we would use 25 zeros because we have to use 35 years. So obviously, every time we have to use a zero, it's going to bring your average monthly wage down slightly. But as you can see in step 3, the result is your average indexed monthly earnings. It's called your indexed monthly earnings because we take your wages, step 1, we take your wages and adjust it. We put them in today's dollars. The best way for me to show you how that works is to look at one of our fact sheets. I bring this every time I give a presentation. I love this fact sheet. It's also available on our website, and it changes every year. So this fact sheet here is for individuals born in 1955. That means they're turning 62 in 2017. So when we get into 2018, we're going to have a new fact sheet for individuals born in 1956. We have to do that because those indexing factors change every year. So the front side of that fact sheet's on the left and the back side is on the right. So on the right, you see columns A, B, C, and D. So column C is the indexing factor column. So literally you take your wages and multiply them times that indexing factor. So, let's say in 1991 you made $20,000. Well, we're not going to use $20,000. We're going to multiply $20,000 times 2.21. And that's what we're going to use when we calculate the retirement benefit, if it's one of the high 35 indexed years. Now, as I mentioned, this person was born in 1955, which means they turned 60 in 2015. So if you can look at 2015 on that fact sheet, you'll see that the indexing factor for 2015 is 1. So basically what that means is once an individual turns 60, we do not give their wages a higher value. What they make is what we use, which, we still are going to use it. We're just not going to give it a higher value. So remember, it doesn't have to be 35 years in a row. It doesn't have to be the most recent 35 years. And you don't even need 35 years. You only need 40 credits, which is a minimum of 10 years of earnings. So here's a question. I am 72 years old. I still work part-time as a registered nurse. I am receiving Social Security benefits, and I am also paying into Social Security. Am I going to receive more Social Security since I'm paying in? It's a great question. I get it all the time. Every time I go out and give a presentation, somebody will ask this question. And the answer is, I don't know. I don't know if you're going to receive more Social Security. I mean, yes, you are paying in because you have to pay in on every dime that you make. Even though you're a beneficiary, you still have to pay FICA taxes if you're working. The reason I don't know if it's going to give her any more Social Security is because I don't know if her part-time job is going to be one of her high 35 years. But what I can tell her is we will automatically recalculate your benefits every single year that you're working. So if 2017 ends up being a high year for you, So your part-time work did make it a high year. Maybe you had a 0 in your computation. We're going to use that part-time work. We're going to drop a 0 year. We're going to recalculate your benefit, and we're going to give you the increase effective with January and continuing. So if her wages, her part-time work was in 2017, we would recalculate her benefit in 2018. We usually get around to those recomputations around October, November. She could bring her W-2 form into the office and ask us to do a recomputation for her once she gets her W-2, or she doesn't do a thing and we do it automatically. And again, if we're doing it in September, October, and it does end up causing an increase in her benefit, we're going to pay her the increase retroactive all the way back to January. So we already covered retirement benefits, making the right decision on when to file, early versus delayed. We covered spouses, divorced spouses. Now we're going to cover survivor benefits. So survivor benefits are payable to numerous individuals. A minor child. If you have a client who passed away, if they have any minor children, that minor child or minor children will qualify for 75% of the deceased full benefit until the age of 18. If they're in high school full-time at the age of 18, they get it until they're 19 or graduate, whichever comes first. Same with a disabled child. Just as I mentioned earlier, how if a disabled adult child has a mom or a dad that files for retirement, they qualify for 50%. It's the same for survivor benefits, but then they qualify for 75%. So if mom or dad passes away and they were disabled before the age of 22, they would qualify for disabled child's benefits. And then the one we're really going to focus on for this webinar is the widows and widowers benefits. So a widow or widower's benefit, you can get as early as 60. Unless the widow or widower is disabled, then they can get it as early as 50. And of course, if they want the full widower benefit, they wait until their full retirement age to file. It's also payable to a parent who has a minor in their care. So if you know of a young spouse, a young couple, and say he unexpectedly passed away, at the age of 30, he has 2 minor kids and a wife. The 2 kids obviously qualify, but the wife would also qualify if she had a child in her care under the age of 16. She would get those benefits until the youngest turned 16, but she does have the earnings limits, just like the retirees do. And we'll get to that in 1 minute. So the survivor benefits for the widow and the widower are what we're looking at right here. You get 100% of the deceased full benefit if you are at your full retirement age when you file. So in other words, let's say my husband passed away when he was, 55 years old. So obviously he never filed for Social Security retirement benefits. He wasn't getting disability when he passed away. He wasn't getting anything, and he passed at the age of 55. And I'm also 55. Well, there's nothing payable to me because I'm only 55 years old. But once I turn 60, I can file on his record as a widow or a widower. Now, if I did, I would only get 71.5%. I'm not going to get the full amount. And it's going to be what his benefit would be if he were living, his full amount. He didn't file for reduced benefit. He wasn't getting anything. So I'm eligible for what his full amount would have been, but then we have to reduce it because I'm filing at the age of 60. Now, a different example would be, let's say my husband filed at the age of 62 for retirement benefits, and he chose to take that reduced amount. So in that one chart that we looked at earlier, the reduced amount in that example was $750. His full amount was $1,000, but he chose to file at 62 and collect $750. Now we're in our 80s and he passed away. I'm his widow. I am eligible for 100% of whatever he was getting at the time of his death. So I get 100% of his benefit, which he chose to take a reduced benefit. So I also get that reduced benefit. If he chose to delay to age 70 and he was collecting that $1,320, then I, as his widow, would be eligible for that whole $1,320. A survivor can file anytime they want once they're 60. I mean, you don't have to file right at 60 just because you're a widow or widower. You can file whenever it's appropriate and makes sense for you. So let's look at the difference between the spousal benefits that we covered earlier and now the survivor benefits. The obvious difference is when you're referring to spousal benefits to your clients, that means they're living. That means the worker is living and there's a spouse. When you're referring to survivor benefits, obviously that means someone is deceased, and we're looking at survivor benefits. So for spousal benefits, they can't start any earlier than age 62. But for widows and widowers benefits, they can start as early as age 60. For spouses benefits, the most you absolutely can get is 50% of the worker's benefit, which is also reduced if you file before your full retirement age. For survivor benefits, the widows and the widowers benefits, if you file at 60, you're going to get 71.5%. 100% of whatever the deceased is receiving at the time of their death is what you get if you wait until your full retirement age. And the divorced spouses qualify, as we mentioned, for the divorced spouses, but also divorced spouses qualify for surviving divorced widows benefits. I literally just got that question this morning from a financial planner. He was like, I know my client's divorced. They've been married over 10 years. She's not remarried. I know she could get something when her husband was alive, but he just passed away. I'm thinking she can't get anything now. The answer is yes, she can. There's surviving divorced widows benefits as long as they meet the other criteria. Common question that comes in, my wife passed away last year and I will be 60 next February. Can I file for widower's benefits on my wife's record? Well, there's a whole lot more that I would need to know before I could actually answer this question. But, you know, first of all, I know that he's old enough. I mean, you only have to be 60, right, to get widower's benefits. I'm assuming his wife has 40 credits, because if she didn't have 40 credits, he wouldn't be eligible for anything because she's not insured. So the main concern here would be, yes, you can get it next February when you're 60, but you know, you can't make over the annual earnings limit, and that's $16,940. So I'm assuming this gentleman must be retired if he's asking that question, but I would certainly have to find out about that. So the answer is, if he is retired, yeah, you can file on your wife's record at 60, and then you can switch to your own record when you're 62 or at any point after that. Maybe this gentleman can file on his wife's record as a widow, and he really doesn't need more money at that point, and he can afford to wait until he's 70 to switch over to his own retirement benefits. That might be a very viable option for him. Here's the earnings limits that I have talked about quite a bit over the last several slides. These earnings limits apply to everyone getting a Social Security benefit before their full retirement age. The only exception is disability, and we're not really covering that in today's webinar. But if individuals are getting widows, widowers, spouses, mother's benefits, retirement benefits, and they file before their full retirement age, they have pretty strong limits. $16,920 in 2017. Next year in 2018, it's $17,040 a year. So it has gone up slightly. The year someone turns their full retirement age, their limit jumps up dramatically. And if you could look at my example under where it says $1 for every 3. So if somebody makes more than, I should have said this, but if they make more than the $16,920 in wages, this is strictly wages, earned income, we withhold $1 for every 2 that they make over the limit. The year someone turns their full retirement age, their limit jumps up, and then we withhold 1 for every 3. But look at the example. Say your client is turning full retirement age in June of this year, in June of 2017. Well, that client can actually earn $44,880 from January to May. and nothing happens to their benefits. But remember, they're filing 5 months early, so they would have a 5-month reduction. And then, of course, when someone turns their full retirement age, they can make as much money as they want. Now, these earnings limits, again, are earned income only. So we don't care about pensions, IRAs, 401k, dividend income, casino winnings, lottery winnings. None of that really matters. Question, I'm approaching 62 years old and I want to start drawing Social Security retirement benefits. However, I may go back to work in the next 2 years. Can I shut off my Social Security at that time until I fully retire? That's a great question. And again, I don't have a definite answer for them, but what I would say is you don't shut off your benefits. You can withdraw your application and repay the money that you received from us if it's been within 1 year. So if you have a client who filed within 1 year of when they want to go back to work full-time, they could withdraw their application. They do have to pay back all the money that we paid them, but we don't charge them interest on it. And then it's like it never happened. But if they've been collecting for over 12 months, or the withdrawal idea just doesn't sound good to them, then we don't shut it off if they request it, but we do put individuals in work suspense. So let's say this individual contacted us when they were 64 and said, hey, I got this great job. I'm going to be making around $80,000 a year. Well, we're going to put in the computer an estimate of $80,000, which is immediately going to suspend them. They're making well over the limit. Even withholding 1 for every 2, there's no money payable to them. So they would be in work suspense. And then we're going to adjust their benefit once they turn full retirement age based on how many months they actually were suspended. When your client's ready to apply for benefits, I would encourage them to go online. The only thing that we talked about so far that you can't do online is survivor benefits. Survivor benefits, that application is not on our web at this time, so you would have to call the national toll-free number and make an appointment. But retirement, spouses, divorced spouses, disability, and Medicare all can be done online. But if you have a client that doesn't really like to do things online, they absolutely can call our national toll-free number and make an appointment. We have reps there between 7 a.m. and 7 p.m. And again, we do pay a month behind. So if somebody's due benefits in January, they're going to get that payment in February because we always pay a month behind. But you can apply for benefits 3 months in advance, 3 months and no earlier. Do IRA withdrawals cause a portion of your Social Security benefits to be taxed? What about annuity income? Just got that question the other day, actually, from an advisor. Great question. My answer is, I really don't work for the IRS. I couldn't tell you, but what I can tell you is that your Social Security benefits might be subject to taxation depending on your client's combined income. So if, in this question here, if the client's IRA withdrawals and annuity income are part of their adjusted gross income, then yep, that's going to factor into them possibly having to claim their Social Security benefits as income on their tax return. I'm not going to get into this too heavily, but I'll let you look at that for a second. And of course, this is on our website as well. Medicare, I do caution financial planners to not give out too much advice when it comes to Medicare. We are not the agency that administers Medicare. Social Security is the agency that does all the enrolling and disenrolling in Medicare, and that's why we have to talk about it. Medicare A and B is what's called your traditional Medicare. That's your red, white, and blue Medicare card. Medicare C and D have, they're rather new. C is your Advantage plans and D is your drug plans. We're going to talk about the enrollment in A and B because that's what Social Security gets involved with, the traditional Medicare. The reason I say I wouldn't do too much advice if I were a planner is because if somebody enrolls, if somebody doesn't enroll timely, they have penalties, and those penalties stick with them for life. So I know you all don't want your client to blame you for some penalties. So if they have enrollment questions, I would recommend to them to contact Social Security. Medicare eligibility is for individuals 65 and older, but obviously there's other people that get it as well. People on disability get it after 2 years, Lou Gehrig's disease, kidney failure. they are also on Medicare. So I had an advisor email this question to me. I'm not filing for Social Security until I'm 70. Do I have to sign up for Medicare next month when I turn 65? So the answer depends. That's kind of a common theme, right? If the client is working, so they want to know if they have to file at 65. If this client is working and they have health insurance through their active employment, they don't have to have Medicare because their insurance is primary. They can decline it and then pick it up once they leave employment or lose their health insurance, whichever comes first. And that is actually called their special enrollment period. But actually what I would advise that advisor is, you know, your client should probably call Social Security. We do have a special enrollment period. It sounds like they qualify for it, but I would have them contact Social Security because, again, you don't want to get into too much trouble when it comes to making that type of advice. Some of your clients are probably paying more for Medicare than most. That's if they have a high income. So this was a question that came in. I liquidated a stock, reported a gain, increased my income to 170 grand. Will this one-time stock transaction cause an increase in my Medicare premium? Yes, it will. It's called the monthly adjusted gross income. And for your clients that have, again, on the higher income levels, they're going to be paying more for Medicare than the standard premium. So the standard premium in 2017 is $134, but the higher income earners probably have an added premium added on to that. So the answer to that question is yes, your client will probably have an increase in their premium, and that increase is for 12 months, and then we're going to readjust it again the following year based on their income the next year. I'm going to talk about some online tools. You guys have to stick with me for this because this is fantastic. First of all, I would recommend to you to encourage all of your clients to create My Social Security accounts. That's how people are going to be doing business with Social Security in the future. It's pretty easy for them to create an account. You can't create an account for your clients. You certainly can help them. You can't do it for them. So your clients just click on My Social Security at socialsecurity.gov, and they either sign in if they've already have an account, or they're going to create an account. Anyone 18 and older can create an account as long as they have an email address, valid Social Security number, and a U.S. mailing address. This is what it looks like. I'm going to assume that all of you on today's webinar probably already have your account because it is imperative that individuals create their own My Social Security account. So this was a great question that I got not too long ago, and it just really made me think, can I request benefits the same day I open a My Social Security account? This advisor had a client asking that, and he's like, I really don't know. And the answer is absolutely. You do not file for Social Security benefits in your My Social Security account. You don't have to have a My Social Security account to file for benefits, but you still would want to have a My Social Security account. As I mentioned earlier, that's how you're going to look at the statement. So you want your clients to provide you with their statement, then that's another reason why you would recommend them have a My Social Security account. They need to make sure their wages are posted accurately. This is very important. Plus, how do they know if somebody's working under their Social Security number? You know, we have had a company have a major breach recently that we've all heard about in the news. How do they know if somebody's working under their number? This is how you know. Check out your wages every year. But this is the best stuff. When people are getting benefits, they now can maintain their benefits online. So this is huge. No, our clients, or I shouldn't say our clients, our beneficiaries have never been able to look at their information before. So not only do they see the current monthly amount, but look at this. They can look at 2 years of historical payment data, and they can drill down and see if anything's coming out of their monthly payments. They can get a replacement 1099, a replacement Medicare card. They can change their address, their phone number, their direct deposit. You can get replacement Social Security cards in some states. It's just unbelievable what you can do in My Social Security now. And you know, I just really can't say enough about emphasizing to your clients to create a My Social Security account. So obviously through this presentation, you've noticed that I do get a lot of advisor questions. I will answer the questions, but also I direct them to our website because I typically find the answer right online. This is a great resource for all of you. It's the frequently asked questions section right on our website. That's me, Vonda Van Til. I'm the presenter today, the Public Affairs Specialist. That's my email address. If you do have any concerns or questions about what I've covered today, you certainly can contact me. I'm also available on LinkedIn as a connection for you. However, the stuff on the right of this slide is where I want your clients to go. So I'm not the resource for your clients, and I'm taking a big step in providing you that information because I know the professional is going to keep it to themselves. Do not give your clients my email address because I cannot possibly help everyone's clients out there, and I know you understand that. So when your client has to work with Social Security, that's how you're going to want to send them. Website first, national toll-free number second, and then we also have local offices. Most of them are open to the public Monday, Tuesday, Thursday, Friday, 9 to 4, and on Wednesdays, the office is closed at noon. So that's how you're going to want to refer your client. And to the left is my contact information. That's the last slide I have, and I'm going to pass it on to Brendan and see where we're at.
Thank you, Vonda. We have a lot of questions that we've been receiving throughout the webinar, which is awesome. So I'm going to go ahead and try to read them in rapid fire mode so we can try to get through them all in the next 8 to 10 minutes.
Okay.
So the first question is, let's go ahead and pull that back up here. Are children younger than 18 eligible for 50% each or in aggregate?
Good question. So children are eligible for 50% of mom or dad's full benefit amount. If mom or dad are living, it's 50%. However, there is a family maximum on each record. So for example, let's say dad retired and he has 3 kids that he adopted and they're all under the age of 18. Chances of all 3 kids getting 50% are slim to none. So what we do is we take the family maximum and subtract what dad's getting and then divide the remainder by 3. So usually when the 3rd kid maybe turns 18, they go off the rules. The other 2 will start getting 50%. But it's not always 50%. It just depends on how many dependents there are. Good question.
The next question, will we receive a copy of these slides? Well, you will be receiving a web link to the entire webinar recording on which you'll be able to view the slides. I'm not sure that we actually released the slides themselves, but at least we'll certainly be able to show you the webinar recording. How long do you need to be married to get spousal? Now, I know that it's 10 years you would have to have been married if you get a divorce. Is that so? Is that different for the spousal if you're not divorced?
Yes. So divorced spouses benefits, you have to be married for 10 years prior to the divorce. But a current spousal marriage, I believe, is 1 year. So if someone has a spouse that passes away, I think the duration of marriage is 9 months. But if you're both living, I think the duration of marriage is 1 year.
And a related question, spouse is only able to get half of normal retirement. If spouse waits until 70, does spouse get half of value of 70?
Good question. So for spousal benefits and divorce spousal benefits, the most you can get ever is 50% of your spouse's full retirement age amount. So, if my husband files when he's 70 and I wait until I'm 70 to file as his spouse, there's no point because once I'm full retirement age, that's the most I can get. Waiting till 70 to file as a spouse makes no sense. Now, I can't get anything on my husband's record until he files, but I wouldn't wait until 70 just for the sole reason of trying to up my amount because it's not going to get any higher once I turn full retirement age. But remember, you don't file as a spouse if you can get more on your own record. You're only going to do so if you can get more as a spouse. But if you can get more on your own, you stick with your own.
Now, Vonda, I don't know if you can answer this next one because this sounds like we're moving into the area outside of the scope, into the area of advice, but we'll give it a shot anyways. I am 64, date of birth, October 1953, and my wife is 54. Born in October 1963. Should I pay her more to build up her benefits till she retires? Looks like she's employed by her husband also.
Sure. Well, that's a good question, and we do get asked that a lot, actually. I don't, I don't really know. I don't know the situation enough, but what I can tell you is the more your wife makes, the higher her own retirement benefit is going to be. So if your goal is to jack her retirement benefit up as much as possible, then yep, you would want to continue to pay her more. However, you need to remember that if her own benefit is small, she can get half of yours anyway. So you kind of have to weigh the pros and cons of all those factors that are involved.
And the next question, do you use the last 35 years or the average of 35 years in the computation?
Right. We do not use the last 35. We use the highest 35. Always the highest. So there's no rhyme or reason to what years we use. We put them all in today's dollars, and then we're just going to pull out the best. So it's very sporadic.
For divorced and then remarried couples, is there an option as to which spousal benefits someone applies for?
Yes. Well, if you're remarried, you cannot file as a divorced spouse because you're currently married to someone else. So if I have an ex-husband out there, but I currently remarried someone else, my only option is to get spousal on my current husband. But if I have two ex-husbands out there, and I was married to both of them for over 10 years, and I'm currently unmarried, I'm not remarried to anyone else, I have two options. I can file on ex-husband 1 or ex-husband 2. I'm going to file on the higher of the two. If one of them passes away, then I'm going to switch and file on the deceased record because you get more when they're deceased. If I ever remarry, then that would terminate my divorce spousal benefits. If I'm getting a survivor benefit, I can remarry after the age of 60. I think I forgot to mention that, but survivors can remarry after 60 and continue to get their benefits.
Okay. Can a widow file on deceased spouse's record once remarried? If collecting on the widow's record then remarries, does it impact the benefit?
Oh, I just answered that. Absolutely. You can remarry after the age of 60 and get a widow or widower's benefit on the deceased. Yep.
Okay. My client's spouse does not have 10 years of earned income. Can she file a claim at her age 62 on her husband's earnings? He will be age 67 at that time, which is his FRA.
Yes. If someone doesn't have 40 credits, then they're completely dependent on their spouse as far as when they can start collecting. So if your client, if it's full retirement age is 67, and he doesn't file for anything until he's 67, then she can't get anything either until he files. If he wants to file at 62, then she can start collecting on his record as long as she's 62. Bottom line, she has to wait for him to file in order for her to get a dime on his record. Yes.
Are the early years of the 35-year average adjusted for inflation?
Every single year someone works, we will index it in today's dollars until they turn 60. Then it's no longer indexed.
Please review the 3 steps in computing the benefit amount.
The first step is putting everyone's wages in today's dollars. Second step is pulling out the highest 35 of those years. The third step is coming up with their average indexed monthly earnings. Now, the actual computation is much more involved than that. It is on our website, but that's the basic 3 steps that I showed.
Doesn't everyone who is not collecting a monthly benefit have to sign up for Medicare Part A, even if they are working and covered under a group health plan?
Good question. I didn't cover that because I was running out of time, but thank you for asking that. So no, you do not have to sign up for Part A or Part B if you're working and covered under a health plan through that active employment. So a lot of people think they have to have Part A, or a lot of people think, oh, I'll just sign up for it because it's free. No, you don't have to. Plus, if somebody has a health savings account and they sign up for Part A, they can no longer contribute to their health savings account. So we really have changed how we're promoting signing up for A and or B. We used to say, hey, it's free, you might as well sign up. We don't say that anymore because people like to use their health savings accounts and they like to continue contributing to them. So no, you don't need A or B until you lose that health insurance or leave employment, whichever comes first.
Should I wait until full retirement age to collect benefits if my spouse is 7 years younger than me?
Well, that's I really don't know what you should do. I mean, if you wait until your full retirement age, you're going to leave your spouse a higher benefit. But if you wait until 70, you're going to leave your spouse even more money if you pass away first. So, you know, whenever you decide to file, you're right, will greatly affect how much your surviving spouse can get if you end up passing away first. I'm assuming you're saying because she's 7 years younger, you're thinking you're going to pass away first. If you want to leave your spouse the most you can, then you would actually wait until you're 70 to file.
Are my spouse's benefits on her own record reduced by my working income until FRA?
No, if your spouse is getting benefits on her own record, then she is not impacted by your work. She can make the $16,940 and you can make the $16,900. If you're not working or if you haven't filed for Social Security yet, that doesn't impact her. Even though you file a joint tax return, it's all W-2 based under Social Security number. So as long as she doesn't have a W-2 on her Social Security number making over that limit, nothing happens to her benefits.
Great stuff, Vonda. Thank you. Do you have an email? And you do, Vonda. It's right up there on the left of the screen above your picture.
Yep.
Okay, excellent. If one spouse is 67 FRA, the other spouse is only 62, can the younger spouse collect on the older spouse's earnings, assuming 50% of the older spouse's benefit was larger than 100% of the younger spouse?
Well, yeah, the younger spouse absolutely will file on the other spouse's record, but they can't get anything until they file. So, for example, if I'm the 62-year-old and my benefit's pretty small, I know I can get more on my husband's. I'm going to file on his record. It's just a matter of when. I have to wait for him to file before I can get that additional money. But I absolutely will file for it. We do it automatically at Social Security. If my husband files, they're going to ask about his spouse, and then they're automatically going to look at my record, and they're going to be like, oh, she needs to file on your record too, and it's all done automatically.
A technical question on the webinar. My presentation shows no slides, only audible, and that may be because this individual connected through the phone but not through the computer. Will I be able to get a recording showing both? And the answer is yes. This is being recorded in full. It will be streaming from the NAIFA website, and so when you get that link, you'll be able to see both video and hear audio. And I know that we are out of time. We're going to try to plow through these last couple of questions and still respect your time today. And if you're not able to stay with us, then of course this is being recorded and you can hear what you missed and see what you missed later on at your convenience. What income level is used to determine the higher rates for Medicare B, individual or joint AGI?
It's your joint. It's on your tax. It's however you file your taxes. It's your adjusted gross income together. And I believe, I'll just pull that slide up because there's a lot of details on that slide. I believe it's, yeah, there it is. It's the modified adjusted gross income on your joint tax return.
How can an eligible X find out the amount his or her X's amount is to know if filing for the X's is a better option?
Yep, great question. So obviously you can go online and get your own estimates, but how do you get an estimate of what you could get, for example, as a widow or a widower or a divorced spouse? You would want to call our national toll-free number. Again, we have representatives available 12 hours a day between 7 a.m. and 7 p.m. because you're not going to be able to obtain that particular information online. So you're going to want to call that number.
And another question, just to clarify, if my spouse is 62 in 2018 and I don't turn 66 until 2022, assuming she has her own benefit of $500 a month, does she get the lesser of 50% of my full benefit or 100% of hers?
Well, she's going to always get the most she can get on her own record first. And then if her full benefit amount, not necessarily what she's receiving, because she might have filed early, but if her full benefit amount is less than half of your full benefits, she will also get additional spousal benefits. But if her own full benefit is more than half of yours, then she will not file as a spouse.
What is the best way to calculate for WEP or GOP?
Yes, good question. So when somebody works for a non-covered employer, meaning they don't pay into the Social Security system, but they also worked somewhere else where they did pay into Social Security, they will have offsets on their benefits because of that non-covered employer that they worked at. It's called the windfall elimination provision, which is WEP. And then if they want to file for spouses or widows, it's called the government pension offset, which is GPO. The best thing to do to get details on that is to go to our website, which is socialsecurity.gov. You see that on the bottom there of that slide. Go to socialsecurity.gov and right in the search box, just type in WEP or GPO, and all the information that you need will pop up. We have a calculator for WEP. We have a calculator for the GPO, which is super helpful because there's no other way that you can get those benefit estimates with those offsets.
And we have time for one more question. If you didn't get your question answered, we will certainly be providing these questions to Vonda so that she can follow up with you later on, and thank you so much for doing that. Last question, spouse is 2 years younger, had fewer earnings and filed at 62. Younger and higher wage earner plans to work to 70. Can current age 62 spouse refile at her FRA to get 50% of the younger and higher wage earning spouse who plans to not file until 70?
Yeah, she will never get 50% of his full benefit because she took her portion early. So she'll get the difference between her full amount and half of his full amount. She'll get that when he files, but it'll never be exactly half because she took her portion early.
Excellent. And we're going to go ahead and sneak one more question in. Gentleman thinking about getting married. He's 58 and has been collecting Social Security since childhood because he was disabled. His partner is 61 and still working. The concern is, will the partner collecting Social Security income lose his benefit once married? Also, the working partner has a home. Will that affect the other person's Medicare, excuse me?
Yeah, well, when you're getting Social Security benefits, it's based on how much one has worked and paid into the system. It's not based on need. So if it's Social Security disability that the individual's getting, then, you know, getting married and having the income from the partner and a house and all that, that doesn't matter for Social Security. But if the individual is getting SSI, then it absolutely does matter. Living arrangement can change the amount. Having your own house, because your assets change, that will affect the amount. So you really have to look into that one a little bit deeper and see, first of all, if the person's getting disabled adult child benefits, they can't be married. So maybe they're just getting disability benefits. And you have to figure out, is it Social Security disability or SSI disability? So there's a little bit more detail we would need to know to answer that question.
Excellent. Well, thank you so much to all of our attendees for participating in this informative webinar. And thank you also especially to our presenter, Vonda Van Thiel. As I mentioned, this webinar was recorded, and you will be receiving an email that will have the link to the webinar recording. This concludes the NAIFA webinar.
Thank you.